Hey traders, welcome to the channel. I'm your trader and trainer, Mr. Paras Kul over here. So in today's video, we are going to continue the previous concept that we have discussed in the last video regarding the opening bell trade. And today we are going to generously understand the very significant thing that is going to change your trading game forever. Most of the traders wish that they can live a lavish life. Lavish doesn't always means money, because money will come when you are into trading. Money is the real input over here and it is also the output over here. But what's better than money is always the time. You can never buy time. But if you are somewhere in your journey, in your trading journey, you use a little bit time to make a genuine amount of money, that's where the freedom lies. And that's why we are going to discuss in today's video the one trade theory that is going to be awesome. And also it is going to change the perspective that you have by looking the markets. Not just we are talking about the technicals or the fundamentals over here. They are also going to have the minimal risk in this setup, because in either way, you are risking less than what other traders do. Always remember, when you take multiple trades in a single day, let's say over here, if I take 5 to 7 trades, and many traders I have seen they're taking 70 to 80 trades in a single intraday market, that's kind of a very sorted plan to blow out your account. And if you have experienced the same journey that you have blown up your accounts and you have lost a lot of money in trading, it is one of the concepts that is going to make you understand how not to lose your money and generate some genuine income, rather than having unrealistic expectations towards a return and having no money policy in your wallet. You are going to generate money and time as well. And that's why we are discussing the opening bell trade. That means we are only trading once a day, one single order a day, with the logical explanation and with the logics that has never been defined before. And these are the pure simple logics. Once you will watch this whole video, you will have the clarity to identify how can I sell from exact this level and make this quite profit in the market. How can I buy from this level and then started making towards this side of the profit. And also sometimes there will be stop losses when there will be sideways market, or there will be some consolidation. You're going to have some little bit losses as well. But while this journey continues by having a lot of stop losses and lots of profits, the whole aim is to make money. By the end of the period or the month or the year, you are going to have genuine returns in your case. And how can we actually realize them? So let's understand this technical concept. So in the last video, I have made you understand the point that for looking at the opening trade or opening bell trade in the market, the whole thing is that you have to divide the opening day into two parts. First, you have to look at the second half of the day. That means the previous day. When the market starts at around 9:30, what are you looking at? You're going to look at the second half of the previous day in the markets. And once you have an understanding what does the second half did, you will have a very clear picture in your head that what is going to happen in the next day as well. So let's say example, in any day, what is happening in the markets and how can we decode it? Let's look out over here. And what we need to do is, let's say you're trading at 9:15 at this level, 9:30 at this day. What we have to do is we have to distribute the previous day into two halves. This was the first half of the market and this is the second half of the market. What's significant for you is to look at the second half of the market. And there are very quite few phenomenon that is given over here, which is worth thousands of dollars. And you're going to spend thousands of dollars, not just to learn this concept, you're also paying a lot of trainers that who are not making any results for you. But via this video, I'm trying to convey you a simple message that simple things makes more money than you can ever imagine. And that's why if you look at the second half of the market is very much clear. Either the second half of the market is going to be upside like this, or it is going to be something downside like this. But what's major point is there are only limited three conditions. Either the market will be upside in the second half. Let's say the market started over here. The market created a series of higher highs and higher lows over here. And that's why it is a buying side market. Similarly, if I'll give you any other example of the second half, this, and what do we see? We actually divide the day into two halves like this. And we see that the half of the market started from here and then created a series of lower highs and lower lows and created a sell leg in the market. And some days there will be sideways momentum, which is the third and the last possibilities. I'll show you one example like this. If this is the second half of the day, what did market did over here? The price is consistently creating a series of higher highs, lower highs, and lower lows and higher highs. That means this is a sideways momentum. And there are only these three conditions that are going to happen in front of you. So since we now know that there are only three conditions that can happen on the second half of the day, or it becomes very precise of what can I expect in the next day itself. Okay, so to take the trade in the first opening bell of the hour, what we have to do is first observe the second half of the day and denote, or you can say note down, whether the market is an uptrend or the market is in downtrend or the market is sideways. That's it. These are the three conditions that can happen. Once you have done this, then comes the first opening candle in the market, which becomes highly important when you're trading in the markets. Let's say, for example, in the same day, if you can see that the market is doing what? Market is in the sideways momentum. And what did exactly the first candle did? The first candle tried to be a bearish candle in the market. And whenever there is a sideways momentum, always try to understand is that this opening candle gives you a price action theorem. So over here, what we can see in this price action in the second half of the day, what did happen in the sideways market? The market tried to move towards the upside like this, small move in the sideways market. And then what did happen? In the opening candle itself, the price tried to move towards the downside. Now, this is the hunting out of the liquidity. As we know, guys, that if the price wants to continue towards the upside, the price will always try to create a higher low and then a new higher high. So after creating this red candle higher low, what did the price did? The price went towards the upside, and it's a very simple thing. Now, it might be a little bit difficult for you because this is the first time that you're hearing this concept, but I'll give you enormous example with continuous backtesting and you will be able to understand it very well and decode the whole market. Okay, now coming to the next day, what you need to do is divide the day into two halves like this. Now, this seems very ingenuine kind of price action, but looking at the point, what you can see is the price started over here, the price created something like this and finally went towards the downside. So this is a selling leg in the market. Okay, now try to understand this, people. I have told you in the last video in our channel as well that whenever the price wants to go towards the downside, the price will go something like this, and then finally the market will try to create a lower high and then lower low only. So if the price closed in the lower highs and lower lows in the market in the last second half, look at the first market momentum. What did happen? The market created a buy leg over here, and then suddenly what did happen? The market started moving towards the downside. This is the continuation of the sell leg. And if the market wants to continue this sell leg, the first thing that you have to receive in the market in the opening hour is that the market should go a little bit towards the upside. Now let's connect to the next day. Over here, what did happen? The market started over here. The market created something like this, the sell leg over here. And then what did happen? The buy leg came in the market. After the sell leg, always remember, after the sell leg, there is always a buy leg. After a buy leg, there is always a sell leg. So simply we are using one principle over here, which is actually universal. After the sell leg has been created, the market will always try to create a buy leg and then again a sell leg in the market. If the market has already created a buy leg, the market will always try to create a sell leg in the market. So all you have to judge is whether the market has created an upside momentum or a downside momentum in the second half of the market. So let's say over here, the market created the sell leg over here. So what is imminent? What is going to happen in the market? Always the answer will be a buy leg will be happening in the market. So simply what you can do is, as soon as the market starts and you can see that there is a bearish candle in the market, you can start buying on the opening candle itself. So this trade will come at exactly 9:30. You can start buying above this level. The exact entry and stop loss we will discuss in the next video. But today we are understanding the whole concept of how we are decoding the opening bell trade in the market. And this is a very simple thing. Just few more examples with me and you are going to catch up and you're going to answer before I will actually answer the questions. So you will be able to answer whether the market is moving towards the upside or downside. Okay, now let's look at this major day over here. What is expected? First, you have to divide the previous day into two halves. This is how the previous day was. And if you can see, it is a clear uptrend in the market in the second half over here. And what did happen in the opening of the second day is this, that the market first again created a buy leg. So after this buy leg, what is expected in the market? The expectation is that the market will create a sell leg over here. So as soon as you see any kind of bearish entry into the market, let's say over here, what we can see is a bearish engulfing pattern. As you have seen in this candlestick patterns as well, you will see that this is the bearish engulfing pattern. With keeping a genuine risk reward of 1:2, you will be able to achieve your today's profit as well. And this is a simple principle that after the buy leg, the sell leg will be created. Now, if you want to continue the further trading after the sell leg has been created, you can start buying again. Now, again, over here, the next day, you will see this is the second half of the day. Okay, and what did happen over here? The market created a series of higher highs and higher lows. And like this only, what did happen? The market had a positive momentum on the second half of the day. What did happen in the open session of the next day? If you will see, the market created a series of higher highs and higher lows, and then again a higher high. This means what? This is a continuous buy leg. And what is expected now? You can answer in the comment section. The price is supposed to go towards the downside. And that's why if you will see directly selling from here, that's what we are going to discuss in the coming videos, how to take exact entry and exact stop losses. We have to look at the bearish candle patterns and the bullish candle patterns for the same. And if you're interested in that, I will make a whole video regarding the same. Today, we are understanding how to judge the direction, whether the price is going to go upside or downside into the opening markets. So today, as you can see, the previous day, what did happen? The price was in uptrend. The price started with an uptrend. That means the buy leg continued in the market and the market will now go towards the downside in very high probability. And that is what was expected over here. Now, coming on to the next day, divide the whole day into two halves like this. And then exactly, you have to look how the market behaved. And what did happen over here? This is a sideways momentum. The first market created a higher high, market created a lower low, again a higher high, again a higher low. So this is what known as the sideways momentum. Now try to understand this, guys. Whenever there is a sideways momentum and the next day either will gap up or will gap down or will start sideways. In the two conditions, that is whenever the market is sideways, if the market gaps up, look for buying itself and the market will continue towards the upside. If the market gaps down, you can see that the market will go downside. If the market opens sideways, then you have to wait for the first breakout and only then you can trade in the market. Okay, so these are the simple conditions. I will give you the same in a PPT format in the next video as well, and then you will be able to understand better. Today I had a request for a technical video, so I'm trying to establish the whole concepts on the chart itself. No doubt you might have some questions in the same. You can always contact me, guys. I have put up my WhatsApp link over here as well. You can directly contact me to understand better. However, if you are able to continue this and revise this video for 2 to 3 times, you will be able to answer my next question as well. So what did I say? If the market is sideways, something like this, and the market gaps up, what are we looking for? We are looking for buying opportunity. Okay, and that's what did happen over here. The market started moving or rallying towards the upside like this. It's up. Okay, now continuing to the next day, and now this time you're going to answer me what did happen in the second half of the market. So this is the half and half. So this was the first half, and this is the next half. What did happen over here? If you look, the market started creating higher high, higher low, higher high, then lower low, again lower high, lower low, and then higher high. So this is what? This is a sideways momentum. And in the sideways momentum, what are we expecting? If the market gaps up, what you can see that in the next day, as soon as the market opens, the market gaps up. And where did it rally? It rallied towards the upside. So again, we can have a positive day towards the end, right? Now coming to the next, let's see the second half of the market. So this is the division of the day. In the second half, what we can see is the market started creating lower lows and lower highs over here, and then a small structure or a small buying leg come over here. So what did happen in the market? The market first created a sell leg over here. The market created the buy leg over here. So what can we expect over here is, this is a kind of a confusion that you might have some days, but that's okay. These are the days when you might hit a stop loss over here. So you have to beware of these days if you don't want to trade in such a scenario where you can see the two price action coming in forward, because this is a kind of a V-shaped recovery. Okay, and we were going to discuss many technicals in the coming videos as well. So do not forget to subscribe to the channel and also ask your questions on the WhatsApp or in the comment section. I'm always replying to you guys. And if you have any queries, you are most welcome. But try to understand this concept. This is a way, this is a V-shaped recovery over here. And that is significant. As soon as the next day opens, what did happen? The market first gap down and then started creating a sell leg over here. Now, if you will look principally, what do we need to do? As soon as the price creates this major buy leg and market gaps up, what are we looking at? We are looking at the selling momentum itself. But the major thing is, you might not get a good risk reward over here. Even if I try to sell from the opening candle over here and I'm trying to getting a risk reward of 1:2, you will see that the market actually consolidated and never achieved our 1:2. The market consolidated for the whole day, and this is one of the time that you might hit stop loss or you might have a break even itself. So we have rules, advanced rules for the break even itself, but we are going to discuss them later. Okay, continuing to the journey now, look, dividing the day into two parts like this, and now looking at the major momentum. What did happen in the second half? The price is in an uptrend. What did happen? The market created a small leg over here and then finally buy leg over here and then close upside. What is expected in the buy leg? If the market continues or market gaps up, it is highly expected the market will create a sell leg. So after creating this buy leg, always expect a sell leg in the market. That does really happen. Look over here. What did happen? The market gapped down and created a sell leg. So what can I do from here is, as soon as the market starts with the open candle, I'll start having a basically buying momentum. So looking at this 3 candle pattern, we can start buying from this level, putting the stop loss exactly like this, because the next candle is a bullish engulfing candle. So we can trade on this pattern. And now if you're trying to have a risk reward of 1:2, you can directly achieve it. So you have to always remember just one principle. After the buy leg, there will be a sell leg, and after the sell leg, there will be a buy leg. So price in the second half created a buy leg over here. Price gap down. That means it created a sell leg. Now what is expected? That the price will create a buy leg over here and then again a sell leg over here. This is how the natural day trading goes on, guys. After huge legs in the market, if you try to study, there is a sell leg and then there is a buy leg, there is a sell leg again, there is a buy leg again, a sell leg, a buy leg, a sell leg, and a buy leg. And all you have to do is you have to understand and you have to trade within these leg itself. And once the leg is done, once you know that if this is a selling leg, at any point of time, not just the opening trade, let's say if I ask you at this candle what will happen, you can see that the previous leg was nothing but the sell leg over here. So it is expected, highly expected, that the market will create a buy leg. Now looking at the same structure, please tell me what will happen. This is the second half of the market. So let's divide the day, and this is the sideways market over here. What we can see is, where is the last leg? So like this, the price created a sell leg over here and then the price created a buy leg. So after the buy leg, what is expected? That the market will create a sell leg, and that really did happen. At the opening of the market gapped down and creating a bearish candle, completing the sell leg. So after the buy leg, price created what? Price created a sell leg over here, and now what we have to do? We have to just buy, because the price will ought to create a buy leg in the market itself. So as soon as the market gives us a bullish momentum or the bullish candle pattern, we can start buying from here. We can put the stop loss over here and we can directly trade for 1:2 or 1:3 depending upon your pattern cycle. Continuing the same structure, divide the second half of the day, and what we will see is that the price created a series of higher highs and higher lows in the end. That means this is what leg? This is a buy leg, right? So this is a buy leg properly. Now what is expected in the market? If the market gaps up, that means the price will create a sell leg over here. First, the price will create a sell leg. If the market gaps down, that means the sell leg has been done and the market will move towards the upside. And if last but not the least, if the price creates a sideways, you can expect the price to continue the momentum. So now looking at this pattern, let's see what the next day did. Did it gap up? Yes. So price gapped up, and now what you can see is, after the price has created this major buy leg, the price continued this major buy leg over here. Now, if you look over here very clearly, there is no single bearish pattern. The price is moving towards the upside in a huge way towards the upside, and that actually it is creating something like this again and again, again and again, again and again. That means there is a huge momentum, or there is a huge fundamental news in the market, and the market is continuing its buy leg itself. So you need to wait before selling. And what is the wait structure? You need to have a selling pattern in the market. But what did happen over here? As such, there is no trade for today for selling as the market continued towards the upside. And if you don't get any trade till the first half of the day, do not trade after that, because the market might move in a sideways momentum. So always trade in the first half of the market. And that's why the first half is for trading and the second half is for observation. Now, what did we look at? The price was expected to take a fall in the market, but rather what did happen? The price didn't create any bearish pattern. The market moved towards the upside, or actually continued towards the upside. As soon as the second half starts, do not trade into the market. Okay, now continuing from this day, what did happen? Let's create the half of the day like this. So from here, what we can see is that the market did what? The market created a buy leg over here. And then last but not the least, the market created a sell leg. And after this sell leg, the market moved towards the downside. And what are we waiting for? We are waiting for a buy leg. So this is a stop loss day, guys. Why? Because if I'm trying to buy from here, looking at this inside out pattern, if I try to buy, the market did move towards the upside, but didn't give me my target of 1:2. So market did create a buy leg before moving towards the downside again. But the buy leg was there, and I was right in my concepts, but my stop loss hit because I was not able to meet my target. Okay, so sometimes that will also happen. But if you will continue trading in the market, you will understand that there will be very less days of the stop losses in this kind of scenario, and there will be huge profits, in your way itself. So what did happen on this day? The market was supposed to make a huge buy leg, but that didn't happen. The market created buy leg over here, and finally the market created the sell leg again and again, and then again a huge buy leg, and then again a sell leg, again a buy leg, again a sell leg. Okay, now continuing, divide the day into two parts like this, and then what you can see in the last half, the price created something like this, and then something like this. What it is showing that it is showing us the sideways market. The market moved over here. But now if you're looking very easily or very simple, what are we looking at? That this is a kind of a buy leg. In the last half of the day, the market created a buy leg over here, and we are expected what? We are expected to sell or have a sell leg in over here. So looking at this inside out pattern, I will try to sell over here. So this is the inside out pattern. I will try to sell from this level, and I will have a risk reward of 1:2. The market didn't mitigate the level in the first half, but the market moved back, give it a boomerang entry, and then give us a target as well. So this was again a profitable day. I hope you're able to understand this concept. This is a very significant and very easy concept. Once you understand it and once you will practice it, you will have the best confidence in yourself. Okay, looking at the second half, just look at the last wave that the market created. The market created a series of lower highs and lower lows. That means this is a sell leg. What is expected is a buy leg. The market created the buy leg. Now, after looking at this huge move towards the upside, what is the maximum expected thing is that the price will again created a sell leg. So after creating this buy leg, what did the market did? The market created a sell leg over here, putting up a 1:2, 1:3. You can have the targets like this. So I hope that you're able to understand. One more last example that I will do with you. Look at this day. What did happen? The market created a series of higher highs and higher lows and higher highs and higher lows, and market created what? Buy leg. So what is expected from here? So looking at this buy leg, what we know that the highest expected thing is the price will create a sell leg, and the market did that. So as soon as the market will create some bearish pattern in front of me, like this inside out pattern, I can start selling and I can directly target for 1:2. But this day, what did happen? The market was consolidating. In the beginning, the market took out a stop loss, then went down, and again after the sell leg over here, the market continued its buy leg momentum. So this is how we catch the legs in the market and how we make the profits. So out of these 10 days backtesting that we have done, so many days were profitable, 3 days were negative. I think 1, 2, and one more day. Yes, this one was also negative. So 3 days were negative, but 7 days were profitable over here. So this is how the strategy works when you have a higher winning ratio and with a good risk reward, genuine risk reward of 1:2, 1:3 minimum. Okay, so this is the today's video, guys. If you have any queries, you can let me know in the comment section, or you can click on the WhatsApp link and you can directly inquire the same thing with me. And if you want understanding in some other concepts, you're most welcome to write down the concept. I will try to create a video for you guys, and do not forget to subscribe and hit the like icon, guys. Till then, hasta la vista.